Welcome to TradeTheMBI.com. This is John. This report is for the 15th of December here. Well, we talked about it yesterday. We were seeing the DOC, the D Omega right here. Once that orange breaks above the 13.5, we have concerns of short activity, and when it corresponds to our short-term buyers, steel in this case dropping below the cyan, which are also considered our shorts, we know that we have weakness. That takes place right here at a cross day where there's just not a whole lot of activity one way or another, and it's pretty much bought up, but you can see the effect of it. Did exactly as expected. We were just looking for a return back to our ABM trailing stop version right here. Took us right to it. There's still the potential for it to take all the way down to the green ABM, given the fact that this had a continuation. We've still seen in our shakeout reading here the elevation in the warning line of 15, and we've been above that. We're just now cascading below. We don't have a cross yet below of the yellow line in that. When that takes place, I think then you can expect a bit more of a retrace, but we have all these positive extremes right there, so we expect that those algo moves at a minimum are going to get retraced, and the low on that is the 2640 range. Given where we are in the 50s, it's not out of reach, and it wouldn't be considered anything dramatic. The interesting part about this now is the full reset of the steel, but with it below the 13.5, its effective reading is really coming up from above like it is, so it needs to pop back up a little bit. That would give enough strength to really maintain things. Otherwise, I would expect to see a little bit more continuation in the softness at that particular level. And we're not, right now you're just starting to see the rise of the Azure line here on the shakeout as well. If that starts to roll over a little bit, I think that we'll see a little bit more of a pullback in here. And none of this is too dramatic. It's all typical of what we expect for these little pushes, consolidation, little pushes, and consolidation. It's not even retraces. None of this is significant from that standpoint. A little bit less enthusiastic about the readings that we see here from the NASDAQ. It keeps butting its head right up against this peak level. A lot of people are going to see that as the beginnings of a double top. But it still had a continuation of rising shakeout with the histograms above the yellow line, which is still bullish from that general perspective. You got a little reset of the steel short-term buyers. Just doesn't quite have the behind it. There's no real dramatic oversold reset in that, so it's pretty much just in a stasis mode. I don't think we get too upset. The elevated euro here is definitely keeping S&P prices, NASDAQ elevated, and it's going to continue to do so as long as, despite the fact that you have rising U.S. rates, weakness and continued easing for the EU, it's clearly a manipulation by central banks to have it this elevated. But that's nothing new. We've been seeing that case for quite some time. The concern obviously caused people to flee the treasuries for the safety aspect of it, though I think that's going to become a harder and harder case to make given the expectation for significantly rising rates. Of course, there may be some hope that a new Fed chairman is going to reduce that. And really, if they were playing it from a wise standpoint and really do want the economic growth, they will lag any inflation readings with raising rates and not just raise them arbitrarily because they can or because the economy is growing. You really need a justification inflation-wise to do it. And the only way to read that would be to be after the fact. And so right now we're getting a arbitrary raising of rates, which less healthy than it has been in the past. This concern of inflation, and the reality is inflation, while it would spike a reduction in the value of dollar, and that would actually be beneficial from a debt and deficit situation, devaluing the general value of that debt, which is the only way to eventually get rid of the debt that the U.S. has acquired, is through inflation and turning that value of that denomination into just less of an impact given, a ever-expanding inflationary rate. So the raising of rates is not necessarily beneficial from that standpoint if you really want to inflate your way out of debt, which ultimately is probably the only answer, since it doesn't look like they have spending under any form of control or containment. Oil, we dip below the green ABM right here, which indicates that we were going to get further weakness, but any move back above becomes your long pivot point. So this continued decaying shakeout here shows the trend is for lower. The fact that it's been holding up so well is quite impressive, because the reality is we really still should be looking for retest all the way back to the 1055 range on this USO right here. And gold, short little dead cat bounce that we expected from here. We don't see any of this reset that's developing as thing that's going to be sustainable or last very long. And it's simply just because, I mean, you've got a significant amount of damage. You've got a nice improvement, though, back here with the shakeout at minus 11. That's actually within range for a decent little pop. But we've got to probably revisit this dip below the red line first. So maybe we see a couple more days of rise. It may have a little bit more oomph to it. I mean, obviously, you got to go with this reset. It's everything that we look for from a reset standpoint. The only drawback is the short-term buyers have kind of like really expended themselves and are at peak level. If we had had a reset of the steel at the same time of getting that orange, we would probably have a little bit more exuberant view of gold rising. Plus, I think that, you know, again, whenever we're talking about gold right now, I think we have to flip up the Bitcoin, because in fact, I believe that the cryptocurrencies are going to overtake gold as a virtual safe haven, or a movement towards the inflationary hedge or the devaluation of dollar denominations and or any fiat currencies. And moving down to a 10-minute chart, because we get more data every day, so pretty soon we're going to be able to move to tick charts as well for Bitcoin. We got the nice reset, so every time the orange dipping below the red right here, our little buy signals, we hit the 50%. A couple times the next one, we didn't even break below the 23, and we started to get the same dip there, and then sure enough took off. And I mean, that's worth a couple thousand dollar change in the Bitcoin futures right there. So easy to read. I mean, it's pretty clear that the algorithms, so it's just an indication that whenever you get futures or any kind of stabilized contract, the same players that play in the markets that we're following, that our algorithms are based on to track, are going to be effective going into these types of things. We ended up with some overbought situations as we peaked out right up here. We did end up with the steel resets on those, but it wasn't until the DOC spread that took place right about there that we started to get some decay. Came down here to about the 61% Fibonacci retrace, and then pretty much reset right back down over here before it started its next move. So from about 17,700 range, and then taking off here into this 18,400 range at this particular point. So I think that's going to be the one to look for to gauge. It's not always about inflationary pressure. There's just a limited range within it, so there's going to be easy manipulation, but I think it's drawn a lot of attention from the gold trade. So it's something we've been talking about for many months as we started to see the divergence, and there have been some good articles on showing it. So you can see here we ended up with a very soft patch here as we were decaying. Every little buy setup we got was coming off of dip below the red line. All that meant was we were going to retrace those, and then when we made the new lows on the dip below the red line right here, we just continued to cascade and never exceeded the 23% until we get this first buy setup coming through here. It was able to make a little bit of move to the 38% range, but that shakeout, really deep move here, only suggests that you need to return right back there. You're going to need to retrace it on a higher shakeout. So right in here was when things started to look really potentially better from a new buy signal. And so the two little signals, even after the dip on this last one, that's what's led to this move all the way back up to the 50%. And that's because we're starting to see the lower highs, which is a draw to the upper range as our base bottom here is flatlining. So I still expect some weakness, I think, from this overall reading. I'm running long on this one, so I won't keep at it, but I think that we're not going to see too much of a run in any direction at this particular point. I think the bias has to be a little bit more towards flat to soft readings. So just be prepared for that and continue to follow those signals. Though, as always, trade well. We'll talk to you later.